This is Day Trading Vocabulary 101. I'm breaking down the most important terms that you need to know before you ever take a trade. Stick with me till the end because I'm covering every single one so you can actually understand what traders mean when they talk charts, setups, and entries. Let's go. Okay, so let's get started. Here is the vocabulary that we're going to go over, and there are going to be 17 terms that we're going to be covering. So we have the first one on the list, which is ticker. The short symbol that represents a stock or asset, for example, AAPL is Apple. So the Apple company, the iPhone, the MacBook, the iPad, that is AAPL. And that's what you're going to put into the charts or on your brokerage, and that's what you're going to look for. So it's just a translation. So let's just say, for example, Tesla, right? It's going to be translated to TSLA, which stands for Tesla, right? So another one that we can add in here would be like, well, what is NVIDIA? NVIDIA is NVDA. So you want to make sure that you find the right stock, but what you can do is you can type the name of the company into the search bar on your brokerages or on TradingView, and you can look for the exact ticker. So let's look for a stock. Let's say, for example, we want to look for NVIDIA. All we got to do is just go onto their search bar over here on the left-hand side. Right now I'm on Victoria's Secret, but we want to find the stock NVIDIA. So let's just say if you don't know the ticker, let's just type in NVIDIA, and there we go. So now all we're going to be doing is we're going to be looking for where it says stocks, hit that, and it'll be the first one where it's going to be the NASDAQ. That's going to be the ticker, NVDA. So same thing for Apple. Let's just say that you don't know the ticker, and let's type the name of the company. So let's do Apple, and there you go. You can see it translates already, and it's right here, the first one, Apple Inc. in the NASDAQ. So that is Apple. And that's what you're going to put on your brokerages when you are ready to place a trade. So let's just say for Tesla, let's just say you don't know it. Type in Tesla in the search bar. There we go, TSLA under the NASDAQ. So that's on how you look for the ticker. So now number 2, candle, a single bar on a chart that shows price movements within a set time frame. Open, high, low, close. And that right there is where we go onto a chart, and let's just say we're on Apple, for example, and every candlestick that we are seeing here has a mixture of green candlesticks and red candlesticks. So you can see that we are on a set time frame, which is a 4 hour. Every candlestick here that we're looking at sums up of 4 hours. So if you look on, let's just say from here to here, we have green candlesticks. That shows you that there is demand in price and they're buying up the market at that level. But now, within the last 8 to 12 hours, we see that the market was declining. And right now, since it's 12:29, this candlestick hasn't closed yet because the stock market opened at 9:30. So 9:30, 10:30, 11:30, 12:30, 1:30. Until 1:30, that is where this 4 hour candlestick closes. And that is what the set time frame is. Okay. So green candles is buys, red candles means that they're selling the market. So now number 3, support, a price level where a stock tends to stop falling because buyers stepped in. So support just means it's a level or a line where you can draw where you see just nothing but a bounce or it keeps on rejecting. So let's just say, for example, right, and to keep in mind, a price level where a stock tends to stop falling because buyers stepped in. So that's just saying that when the market was falling and falling and falling, we can say that, okay, if it stopped falling, did they start holding the price? Did it start, stop selling off? And could it return right back up? So let's just say, for example, over here, look at this. If we look over here, right, market was selling off, market was selling off, market was selling off. But then look at this. We have now a support. This is support. All this right here is support because the market was selling off, selling off, selling off, but then it found support around these ranges. And when it found support around the ranges, now you can see why the market came right back up. So that is a support line. And on that support line just means that buyers are trying to buy it up. So now let's go to resistance. So it's just the opposite of support, because support is going to be at the bottom, but now number 4 is resistance, but it's going to be the same exact thing, which is those lines, but it's going to be a different direction. So look at this. Resistance, a price level where a stock tends to stop rising because sellers took control. So let's look for it here, for example, right? So let's delete this, and let's delete this, and let's look over here, right? So if you look over here, the market was going up, going up, going up, going up, but then it just fell like crazy. And this right here is you want to draw a line where you see the most reactions, the area where you see nothing but rejections. And that is where you place your resistance, because it's resisting from the market to go up. But when it breaks above the resistance, then there is no more resistance. So look at this. The resistance is at the top, right? Here and here and here and here. That is resistance, right? And if we look on the bottom, if you go back to number 3, then you can see that where is the support? Down here. So buyers are holding this area, right? There you go. Support and resistance. And that is what support resistance means. So if we go back over here, 3 and 4 is just 2 trend lines, or just a simple trend line where there has been a bounce where buyers stepped in, or a resistance where the sellers just took control and tried to take the market down. But now this is where 5 comes in, which is breakout, when the price pushes above the resistance or below the support with strong value, often signaling a big move is about to happen. So if we look back over here, we have the resistance and the support, but you can see that the support held, right? But look at the resistance. When the market was resisting at the time, right? Because that was like 2 or 3 days of resisting. Now look what happened after it broke above the resistance. That's where the volume started kicking in, and that's where the big volatility pushed, right? The market up. So that's what this breakout means. When price pushes above the resistance or below support with strong volume, it often signals a big move is about to happen. So that's number 5. Now number 6, volume. The number of shares traded in a certain time period shows how active and strong a move actually is. So if we go over here back on the chart, and let's look at this big volume move. So what we're going to do here is we're going to go on the indicator tab, and we're going to search up volume. And at the volume section, you can see it's going to be the fourth one. Click that, and you have green and red bars at the bottom. So look at this. When the market broke above, we want to see how much or how many trades were traded during that period. So if we look over here and just hover over our mouse on it, you can see on Friday the 19th of September 2025 at 12 p.m., look on the left-hand side, 4.63 million shares were traded during this 4-hour candlestick. All right, so let's look at another one. So it looks like 71.04K was traded during this candlestick right here. But now look at this one. This big engulfing move that shot the market up very impulsively. If you look on the left-hand side, it says 5.93 million. So that is what the amount of shares were trading during that time. And that's what the volume indicator is for. Now, number 7, when price briefly breaks past support resistance to grab stop losses or trap traders before reversing. So let's look at this. The rule behind support resistance is that you really want to say that the market can hold above the resistance or could hold below the support. In this case, if you look at this resistance here, you see on how there was a fake out. That right there is a trap. And on that trap, this is where it faked so many people out from it to continue going up. Instead, it just continued going down or just reversed. So that is the trap. So you want to make sure that you are careful when you're drawing the support resistance, and when you are trying to trade it, you must see a break and a retest with a better confirmation. So just be careful, because these are traps, which is called liquidity sweeps. Number 8, FOMO, fear of missing out. This is what happens in the beginning, and it's totally normal. all right? Because we all want to make money. We all want to get into some trades, maybe because we're bored, maybe because we feel like we need to be in a trade. But no, FOMO is a fear of missing out when you just want to jump into every single setup, every single trade. And let's just say you have 4 charts open and you're waiting for that one stock to give you that confirmation. You jump, but then it's like maybe you didn't really have a game plan or a trading plan, and that's what caused the FOMO just because you just jumped in. So remember, it's all about following your rules, your system, and your trading plan. And that's going to ease that FOMO just a bit, okay? Number 9, diamond hands. Holding position through big moves or drawdowns without selling. But diamond handing just means that you're holding and holding because you are believing on a stock to continue going up or down, whatever the direction is. But that is what diamond handing is, okay? Number 10, hold, right, which is hodl. Originally a typo for hold, right, because they just switched the L and the D, but it means holding long term regardless of short term price swings. So you're just holding, right? You're holding through the wave, you're holding through the storm, you're holding through the up and downs, but you're holding onto this trade because you believe the direction that you have set is going to hit, right? Number 11, P&L. This is the profit and loss. How much you have made or lost on a trade or an account overall. So this is what you want to check every single day, every single week, and every single month, just so you can see what is your profit and losses. Are you up for the month or are you down for the month? And that's where you're going to learn more about your trading system and how you're performing. And that is P&L. Number 12, FEGs, fair value gaps. Imbalance areas on a chart when the price moved too fast, too quick, leaving behind gaps, often get filled in later. So let's look for example over here. So look at this. On this chart, we can see that there is a lot of gaps, right? So look at this. We have a gap over here. We have a gap over here. And we have a gap over here, and over here. So you can see that most of the time we fill in those gaps. We filled in this one completely. We filled in this one completely. We filled in this one completely and filled in this completely. So you can build a trading strategy around these gap fills. So when you see open gaps at one point, one day, 1 week, or sometime later down the line, those gaps are going to get filled. And that's what gaps are. Number 13, risk to reward, RR. The ratio between how much you're risking and how much you can make. This is very important because you want to make sure that your business is profitable. Risking 100 to make 300 sounds like a plan. It sounds good. So that is 1 to 3. You're risking 1 to make 3 back. So let's go over here and let's do this. This right here is a long position tool, and I want to say that I want to reward myself if I am correct about the market, right? So let's just say your entry is going to be right at this level right here, just like here. And when the market is, let's just say, hits your key level, you're going to enter right here. And when you enter right there, you are already saying that that's going to be your entry. But at the same time, you have already a set target where you want to take the market into, which is rewarding 3, right? Because you're saying that you're risking 1, and that 1, let's say, for example, is $100. And if it hits below this pink line, then you get out and you lose $100. But if it holds and you are right about the market to bounce there, then you get rewarded $300, right? And think about it. If you get reward of $300, then you can afford to take the next trade and you can lose $100, but you're still up, right? And that's why risk reward is very important. Number 15, scalping. A quick trading style taking small profits from tiny price moves within minutes. So that just means that you're like on a low time frame, like on a 1 minute, and on this 1 minute time frame, you are trading these quick up and down movements, but you are quick in and out with it, right? You're making your money very quick. You're trading these up and downs, and that's it. You're not holding on for hours. You're not holding on for days, but you're scalping. What you're doing is you're scalping in between these movements so you can make your money quick, and that is what scalping is. Day trading. Opening and closing trades within the same day, no overnight holds. So you can see basically day trading is the same thing as scalping, but in day trading, you're holding on to those trades a little bit longer or a little bit less, but still you're not holding on to the next day. You're buying and selling within that day, okay? And that's what day trading is. But if you hold on to the next day, then that's not a day trade, that's a swing trade. And so it's the same thing here. So if I'm holding on to a trade, maybe I'm holding on for maybe 30 minutes, an hour, 3 hours, but you're selling before the stock market closes, and that's a day trade. Number 17, swing trading, holding trades for days or weeks, catching bigger market moves instead of intraday noise. So you can see that right at the market open at 9:30 a.m., you see that there's a lot of value, but look at during the midday, there is now chop, right? And that's intraday noise. So if we work our way onto a bigger time frame, you can see that there is less noise. And maybe you are saying that, okay, just because I'm on a bigger time frames, I am holding onto this trade for days or weeks because I'm expecting Meta to go from 738, and that's where it's at right now, all the way to maybe like 800. But I know it's not going to happen today. It's not going to happen maybe tomorrow. I'm most likely going to say that this can happen within the next 2 to 3 weeks. And that is what swing trading is. So swing trading just means that you're not buying and selling within the same day. You're taking it into tomorrow, next week, next month, or next year. And that's what swing trading is. You're swinging it. So if you enjoyed this video, smash that like button and also subscribe so you get notified when I release new videos, because I'm breaking down day trading for beginners very well simplified so you can actually learn and start trading. See you next time.